Silicon Valley Bank has collapsed. This is very important because they were interconnected with a lot of different investors, a lot of different companies, and I'm going to show you those today. You don't have to go anywhere else and search online and everything. I've done all the digging. I spent the hours and hours looking into the information for you. Let's begin by taking a look at this. Current list of companies with Silicon Valley Bank: deposits, Circle, Roku, BlockFi, Roblox, Ginkgo, iRhythm, Robot Lab, Sangamo Therapeutics, Lending Club, and Payoneer. All of them had quite a bit, between the billions and the millions of dollars. What they say here is that their deposits wouldn't be insured because they are above the $250,000 FDIC limit. I'm sure you're aware of that. What I brought up in the previous video was simply that anything above that limit, the uninsured deposits, the FDIC is going to go through, they're going to sell off, get rid of this company, and whatever proceeds they get, they're going to give the scraps back to these people. So maybe you get a few pennies on the dollar. This is not the cause of, some freak accident. This isn't a 2008, and people are pointing to it as if, oh, it's not 2008, therefore you don't have to worry about it. But the understanding is just really so limited for many people, and this is caused by the stupidity of the influencers, not the people. The people are just taking in the information. You have to understand, interest rates rose. That created a problem, and this company was feeling it, and they felt it very hard because over $40 billion of money was pulled out in a matter of 2 days, I think it was. So when you look at this, it has to be an absolute fact of interest rate hikes creating a problem that is actually going on with other companies at the exact same time as SVB. It wasn't just, a little bit of dirty tricks behind the scenes, ninja loans, all these different things that we saw back in 2008 and 2007. No, this is actually something fundamental. That's the problem that people don't realize. Let's move into this. Nearly half of all US venture capital-backed startups were involved with Silicon Valley Bank, as per Bloomberg. And think about that. This means, in fact, they're all somewhat going to take a loss as a result of this. Very significant, as I brought up in the previous video, links are in the description, is quite frankly that you've got all this money that had been flowing in. Absolutely, in the 0% interest rate world, money was flowing into venture capital. Startups were booming, technologies were advancing. Now it's going to stop. Now it's going to actually be held back and say, wait a minute, maybe this is not a good idea. Remember the SPACs? That was so huge. Money was flowing so easily, and I said many times, if interest rates rise, you watch what happens. And now they're not doing the SPACs. Now the IPOs aren't coming out the market. Then venture capital was pretty good, but that slowed down as well. I gave you my personal anecdotal evidence with Amazon and the way that things have been much tighter than they were before. The valuations have gone down significantly. And this is what's happening. Interest rate hikes do create a problem. It's not just people necessarily borrowing at a higher rate. This is a big deal. It isn't a one-off. Financial markets brace for more pain from Silicon Valley Bank death spiral, with First Republic, PacWest, and Signature Bank stocks down by up to 50% as tech giants unable to access frozen billions. That's just the one aspect, the stocks themselves, but look at how this all connects. You gotta understand, this is the detail here, and we're breaking it down. If you don't realize how the impact of the Federal Reserve's methods are going to actually affect you and your business and your investments and everything else, well, then you're in the dark. And that's what those other influencers want to do. Look, commercial real estate should be at the top worry for investors because there is more than $60 billion in fixed rate loans that will soon require refinancing at higher interest rates. Additionally, there's more than $140 billion in floating rate commercial mortgage-backed securities that will mature in the next 2 years, and that is according to Goldman Sachs. So guess what you've got right now? You've got a turnover that has to happen, and when it does, those are at higher rates. What occurred with this particular company, SVB? They bought a whole bunch of mortgage-backed securities at 1.5% and change. That was their yield. They were getting that yield at a time in which other assets weren't giving it yield. However, as time went on, the value plummeted and they lost, I think it was $1.8 billion. That really put them in the hole. This is something that's going to happen with a lot of different companies. We just haven't found out yet. How many? Well, we'll see. But directly connected to SVB are all these different companies that are going to lose. Maybe they're going to get a few pennies back on the dollar. Maybe, but not necessarily. SVB stranded deposits spread the pain from tech to Napa Valley. Roku and Rocket Lab are among the clients cut off from funds. Depositors need more clarity. Ah, yes, that's right. Just like those at FTX, I'm sure. This is showing the fact that Deutsche Bank fell more than 10%. How is this company still existing? Deutsche Bank falling more than 10% this week. You've got Commerce Bank as well. The whole financial index plummeted as a result of this. That could be temporary and you watch, maybe not necessarily next week. Next week's going to be a bloodbath probably, at least on Monday. And you go and look at this down the road, who knows? But this is going to have a direct impact on these stocks in the short term. I'm sure people, I'm not telling you to do this, but people who are getting into short or inverse ETFs, probably in this case are going to do well until a solution comes up. As soon as a solution, even the slightest one, comes around, this will be seen as very bullish. So we need to see something maybe from the Federal Reserve. Maybe they're going to push that up. Now we have this. As banks topple, regulators face reckoning on week of mayhem. Collapses of SVB, Silvergate in a work week stoked market panic. The market was blood red. And so they are trying to come up with some solutions to it, but of course they don't. They won't. People are lining up. You could see it right here. They're trying to, this is Menlo Park, California. They're at Silicon Valley Bank and they're trying to get their money back. They're trying to get their cash. And of course, will they be able to? I have a feeling they won't, but that's just me. All right, look at this. Peter Thiel, Founders Fund, withdrew millions from Silicon Valley Bank. He was one of the individuals that was saying, get their money out. You got to get the money out. And he was able to do that. At least his company was able to do that. I can't say the same for many other companies, though. Silicon Valley Bank chief pressed Congress to weaken risk regulation. CEO Greg Becker personally led the bank's $500,000 push to reduce scrutiny of his institutions, and lawmakers obliged. Yes, that's right. But you got to realize that financial institutions ultimately get away with whatever they want. It's not a real secret. They can do whatever they want, and it's really something that, you see it. You see it 2008. You saw it. You saw it when they repealed all the little provisions that were put in place to protect people. They just repeal them because they want that. They want chaos. With chaos comes opportunity. Opportunity for some companies like JP Morgan to gobble up all of that. Did you watch the previous video I did? Link in the description. And if you're not subscribed, you got to be able to check out the latest. You want all the good stuff, right? You don't want the fluff. If you want the fluff, please do not come to this channel. I don't have fluff, none of that available. But if you want that, other channels will give that to you. SVB's lightning collapse stuns the banking industry. And essentially what they're saying was, this happened so fast, other companies, it would take several months. Financial crisis took several months. This company took 2 days to fully collapse. From like the realization, oh, no, hey, don't worry, everything's good, to, okay, we're completely out of business. This happened in 2 days. Crazy. Crypto shaken as SVB exposure depegs $37 billion stablecoin. This is a USDC. And you can see Circle's USD coin is the world's second largest stablecoin. Around $3.3 billion in reserves were held at Silicon Valley Bank. And that really did a 1-2 punch on the crypto industry, knocking it back down. All cryptos seem to have taken a hit as a result of this. We'll see what happens. Without the Federal Reserve quantitative easing, it's very difficult to push it up. And speaking of which, the Silicon Valley Bank crisis will force the Fed to slash rates by 100 basis points, that's 1%, to prevent contagion, according, oh, that's right, to a market guru, Larry McDonald. So, you got to realize what this is all about, and I think it's quite quite frankly, that we are okay, let me say it like this. We're moving into a zone in which the market clearly cannot withstand higher rates, but it needs higher rates. And so if they actually do, in fact, decide to pull back, they reduce their money, money tightening policy, and they start to actually decrease rates, we could very well end up in a hyperinflationary scenario. And I don't use that word lightly because we are already in a high level of inflation. If they say we're gonna stay tight, but we're just gonna buy mortgage-backed securities, they might do something like this. Oh, that market's not doing well. We're just gonna print money. We're just gonna buy this stuff over here, but we're also gonna be really tight, really strong, and we're gonna make sure that we get inflation down. And we know how this works. And so we can see where they're heading to. And it is a complete devaluation of your currency. And that is extremely important. All of those who have been waiting for the period of time in which we go into high inflation, if they make this mistake, this is worrisome. And people say, great, I welcome it. This is devastating. We need a deflationary period to clear out the waste, the junk, all this garbage, all these dirty companies out there. And instead, it doesn't look like we're going to get that. At least that's where we're headed. So, of course, real assets are where we need to be. At the same time, my personal opinion is that we want assets that are geographically diversified so that we have this in different currencies all around the world, earning from different people, because maybe the US isn't doing so good, or maybe, Florida's doing okay, but New York's not doing okay. We want that geographical diversification. If you are in one spot earning from one place in one currency and you're only investing in one thing, my goodness, the risk is extremely high. I want to just put out a message to everybody out there to challenge your neighborhood-friendly influencer and the pathetic behavior that they've had over the last few years as interest rates tightened. And I warned that they would tighten during this period of time, that this has brought us into a very precarious scenario. As interest rates got higher and higher, I said that they will have to go higher, and still denied by the vast majority. And now here we are standing at the edge of the precipice. And I warn you once again to watch out very closely who you listen to. Thank you.